Welcome back to my channel. My name's Luke. I talk about all things real estate, renovating, and financial freedom. And in today's video, we're going to talk about the changes in the property market. Has FOMO set in and are prices rising too quickly that it's probably getting overheated? Are we really in a bubble, or is it time to take a step back and reassess where the market's at the moment and maybe, hold your powder, as they say, in terms of investing in the property market? Now, there's been a lot of changes in the market in terms of the demand and regulatory bodies bringing in changes to lending that are going to reshape the market over the next few months. It was recently announced that APRA was rising the assessment rate for mortgages from 2.5 to 3%. And what that means is there's going to be less borrowing capacity for the everyday Australian to make a property purchase. Now, for the average couple, that might not be a lot of money off their borrowing power. It could be $30,000 to $50,000, but across the board, this will take a bit of heat out of the market. Now, if they also bring in on the 1st of November, the cap on debt to income ratios around a 6 times multiple, plenty of investors that are looking to grow a large portfolio are also going to struggle to get their hands on debt to potentially make more property purchases. What we've seen on the ground in my buyer's agency here at Purpose Property is a heated market. Things the last 12 months have really been heating up, and especially in the last 12 weeks, there's been a lot of demand for quality properties in great locations. Now, we've been looking to buy in areas by the Bayside, on the north side, and on the south side of Brisbane, and we've been focusing on pockets that have good schools, good transport, and large blocks of land that rent at either a neutral, slightly negative, or positive cash flow, depending on the investor's situation. Now, with all these changes that APRA are bringing in and the banks are going to pass on, and the rising prices that we've seen this year, is it probably time to take a step back? Now, the way I approach this is you need to take a look at your personal situation and understand your risk profile. Are you trying to jump on the heat of this market and ride this wave of growth in the short term to potentially make some quick money? Or are you a fundamental investor that's looking to buy and hold for the long term? There's a lot of common sayings out there, but one of them goes something like, George is rushing out because he doesn't want to hear any more boring sayings. So as I was saying, a common saying in the investing space is the best time to buy was 20 years ago. The next best time is when you have the cash, buffers, and available funds to make your next property purchase. I've stolen that one from the Property Couch guys, so go check out their podcast for some great investing strategies and advice. Now, really, I agree with that sentiment. If you have assessed your buffers, assessed your cash you can lend from a bank or through a broker, and you're comfortable with making a purchase in this market, knowing that there's been roughly a 20% increase across Australia in most of the metro markets, then go out there and make your next purchase as an investment, or go and make your principal place of residence purchase. But if you're just trying to buy in for the hype and make some quick money in the next 1 or 2 years, this cycle might not be for you. For myself, property investing is a long-term gain. We're not trying to jump in and make quick bucks. We are looking for capital growth in the short term to grow our portfolio and access to equity. So we will look for things that have value potential and large land component to essentially get that equity gain and potentially manufacture value through a renovation. But we are investors that want to hold for the long term. That means 7 to 10 to 15 years at a minimum, because investors that invest for less than 6 years typically make a loss based on data and research. So knowing that the heat is going to come out of the market a little bit as they make lending restrictions, and that we've had such a strong run of growth, make sure when you're making a property purchase, you've done a lot of research on the recent sales. We've seen offers that have been way away from the true selling price of a property because people have been looking 12 months ago and not really understanding how recent you need to be with the data in terms of making a informed investing decision for a property purchase today. Now, when we try and make purchases, obviously we get live feedback from agents around recent sales that have just gone under contract or sales that are just about to settle. Now, this helps us to refine our price points and investing decisions. And really, at the end of the day, no one has a crystal ball and no one can see into the future. So if anyone out there on YouTube or you're getting investment advice from that is forecasting a confirmed rate of growth in any location, I'd just be wary of that advice. Now, of course, we want to be researched and well thought out in our approach. So that means understanding why are these locations good to invest in, and if you're working with a buyer's agent or an investment advisor, make sure they break that down for you. Why do they like these suburbs and these locations specifically? What areas should you avoid and why? Are you sticking to the fundamentals of a large land component, or a large land value, I should say, in particular? So based on the economic forecasts by economists at the major banks like Westpac, these banks are forecasting 5 to 10% growth from this point over the next 12 months. And if you're looking to buy and hold for the long term in the Southeast Queensland market, there's definitely still some great opportunities in Brisbane, on the north side, the south side and the bay side to make a great investment opportunity and a great investment decision in this market. Now, I know it's tough and you're probably getting knocked back on plenty of offers, but make sure you do as much research around comparable sales that are within the last 3 months and understand that what point you want to let a property go. So when you do your analysis and you're making offers, make sure that you wouldn't have paid $1,000 more and been happy with that price. Make sure when you make a best and final offer that it truly is your best and final offer. A lot of people wish they had hindsight when they were making offers because they could have offered $1,000 or $5,000 more. Now, we just made a deal this weekend that was only $1,500 apart in the offer prices, and we were successful because we were $1,500 more. Now, sometimes it's meant to be, so as long as you're comfortable with the best and final price you submit, if you miss out, you'll be comfortable knowing that you wouldn't have paid $1 more for that property. Now, if you're interested in checking out why land size potentially matters, hit this video over here. Drop a like on this video if you found this information useful, and subscribe to the channel. I'll see you in the next video. Peace.